Are you going through a Wisconsin divorce and worried about losing your home? Most people think they can't keep their house or buy out their ex-spouses, but special mortgage programs for divorce situations could save your home and your financial future. My name is Jeff Hughes, and I'm the lead attorney at Sterling Lawyers. We are a large, exclusively family law firm in Wisconsin, and we see hundreds of cases every month, which gives our clients an unfair advantage. In this video, I will share 5 essential tips that will help you keep your home, protect your credit, and set yourself up for financial success after your divorce. The first one is there is a divorce buyout loan option in Wisconsin. This is a loan designed just for divorce situations, and it's very different from a traditional cash out refinance. For a regular cash out refinance, usually the limits are you can borrow up to 80% of your home's value. So let's say you have a loan for half of what the house is worth. That means you can access 30% additional incremental amount of that equity to pay off other loans or to use the cash in some other way. But you would need to leave 20% of the equity in the home in order to do the cash out refinance. But that is not the case for a divorce buyout loan. For a divorce buyout loan, you can access up to 95 and even 97% of your home's value. Now, what this means is that you can keep your home even if you don't have all that much equity built up. So let's say you bought the home in the last year or so, and the equity hasn't had time to mature and grow. With this type of loan, you can still do that. You'll get better interest rates than with a cash out refinance, and most often have lower closing costs. And you can access more of your home's value to pay off your ex-spouse. Also, there is no requirement that both parties must have been on the title for a specific period of time, like 12 months or so, in order for this type of loan to occur. Now, here are some really key points about divorce buyout loans in Wisconsin. Now, the purpose is that they allow one spouse to convert home equity into cash to pay the other spouse's share of the equity. For qualifications, the spouse keeping the home must qualify for the loan independently based on their own income and credit. Now, as for a loan type, it most typically is a cash out refinance, but the funds must be used solely for buying out the ex-spouse's equity. Whenever you go to refinance and you're paying on that house for a long period of time, boy, those lower interest rates really make a big difference. And this type of loan may allow retention of favorable loan terms that you have on the original type of loan, such as keeping that same rate, for example. That not always, but that certainly can be the case. And obviously, the new divorce buyout loan must be in the name of the spouse keeping the house. You can't put it in a parent's name or something like that. It has to be in your name. Now, I strongly encourage you to speak with a family lawyer who is experiencing these sorts of things, as well as a professional mortgage broker who has done these and knows what's going on and can navigate you and guide you through this whole process. Now, let's move on to the second tip, and that is know your income qualification. Your debt to income ratio is crucial here. Typically, your gross income, that's before you pay your taxes, must be at least double all of your expenses added up, including what is to be your new mortgage payment. Okay, if you're trying to do this during your divorce, you need to use your regular employment income. If you're self-employed, you need to have at least 2 years of tax returns for the bank to get comfortable with what your income is. You can use your child support payments, and you can use your alimony to add to your total income in order for calculating your debt to income ratio. If you are looking to include your child support and or your maintenance payments, you need to show proof that you've received them consistently for at least 3 months. And I have seen underwriters require 6 months at least. So just know that's there as well. Now, also, here's another really cool thing. If you're receiving child support is not taxed, meaning the paying spouse cannot deduct that, and the government cannot tax the receiving spouse. If you're using child support payments for purposes of calculating your debt to income, most lenders will allow you to gross those payments up 25%, meaning if you're receiving $10,000 a year in child support payments, because it's coming to you with you having to pay no taxes, what the lender will allow is for you to count that as $12,500. So an extra 25%, calculating your debt to income ratio. Okay, that's a really cool thing. So know that that's there too. Tip number 3, protect and guard your credit while you're going through your divorce and after divorce. 1, if it's just you incurring debt, you know that's there. And you need to certainly protect your score, because your score is going to mean everything on whether or not you're going to get this loan. Divorce can wreak absolute havoc on credit scores if you're not careful. A conventional loan requires a minimum score of 620, though ideally, I think you need to be at 740 or higher to get the best rates. Now, if that's out of reach right now, know that, plan around that. If you're close to that, there's some things you can do to raise your credit score. Monitor all of your joint accounts carefully. Watch them, check them every month, make sure all your debts are getting paid. Look, if you've got a bill that needs to be paid and it's about to go late and hurt your credit, it is better for you to pay that and get reimbursement from your spouse, or go to the court and let the judge know and ask the judge to require that, than for your credit score to go down. Now remember, even if your divorce decree assigns a debt to your ex-spouse and that debt is still half in your name, or in your name as well, you're half responsible for it according to the law, if that spouse misses a payment, that can hurt your credit score. So remember what I said, watch those during and after the divorce for as long as you can, and make sure your name's off all of the debt. Tip number 4, consider all of your down payment options. Many people think that they need 20% down to buy a new home, to refinance after divorce. That is simply not true. I've already talked earlier that you can access up to 95, even 97% of the equity in your house. Now, for a primary residence in Wisconsin, you can purchase with a little as 3% down on conventional loans, or you can use FHA loans for 3.5% down. So there's some benefits to using one of those types of loans. And you can apply for down payment assistance programs that are available in Wisconsin. They're tough to get, but you might qualify. Look around for those if you think you might, and apply. There's no harm in applying for those. I know that one of the programs we have here in Wisconsin is the WIDA program, which stands for, I think it's Wisconsin Housing and Economic Development Authority. So check out that program. That might be something that benefits you. Number 5, the final tip here is use debt allocation strategies wisely. Now remember again, Wisconsin is a marital property state, which means debt acquired during the marriage is considered half yours and half your spouse's, even if only one name is on the account. Once your divorce is finalized, debts assigned to your ex-spouse in the divorce decree can be excluded from your debt to income ratio when you apply for a new mortgage, even if it shows up as your name is on the debt. Now, you're going to need a certified copy of your divorce decree, and you're going to have to give that the loan officer or the underwriter, whoever's doing that for the mortgage company. So what does this mean? You can qualify for a new home even if your name is still in the mortgage of your old home, provided that the debt is assigned to your ex-spouse and it needs to be very specific in the divorce decree. Now, if you're doing this while your divorce is still going and you get what we call a partial marital settlement agreement that is about property division. So have all your property and your debt divided in that partial in order for your spouse to be responsible for debt and for you to be able to use that and take to a lender and get your divorce buyout loan done. Also, along with that, your ex-spouse doesn't need to refinance that old mortgage before you can qualify for a new one, so long as the debt is legally assigned to them in that divorce decree. It's real important that you get that, okay? I hope those 5 tips were helpful to you, and understanding your mortgage options is so crucial to making the right financial decision during your Wisconsin divorce and after. Taking early action can make all the difference between keeping your home and having to start over. Now, if you found value in this video, there is another video that I think you'll also get a lot of value out of. So check out this video, Attorney Advice for Selling Your Home During a Divorce. It will give you a complete picture of your housing options so you can make the best decisions for your future. And I'll see you over there.